Imagine growing your capital without spending any time on it. Does that sound too good to be true? Maybe it is a little more complicated than that, but using the stock market, there's lots of ways to earn interest on your capital. Welcome back to Cash Courses, where we make finance as simple as your favorite bedtime story. In this video, we will teach you the basics of the stock market and investing in stocks. Let's start with explaining the concept of the stock market. The stock market is a marketplace where people can buy small pieces of companies. When you buy a piece of a company, also known as a share or a stock, you become a partial owner of the company. Of course, this doesn't mean that you get to make big decisions about the company, but it does mean that your share of the company will increase in value when the overall value of the company does. Naturally, a company has a limited amount of shares, thus meaning your shares are worth a certain percentage of the company. So you can buy a share of a company on the stock market. But why would someone want to sell a part of their company? Well, if a company decides to sell a certain part of its shares, they can raise a lot of money and use it to grow and scale faster. The process of bringing your company to the stock market and selling your shares to the public is also known as going public. So in short, a company can go public to raise a lot of money to scale up, in exchange for a part of the shares of the company. And the investors can profit from this by buying these shares and waiting for the value of the company to increase. All of these transactions are done on the stock markets. Now you understand the concept of the stock market and why a company would actually want to sell its shares. The last topic we want to cover in this video is the price of a stock and how this is actually calculated. As we explained, a company can go public and decide to sell a part of its shares. In this case, the company can decide the price of the shares itself, often based on factors like their performance, industry, growth prospects, and many more. But what happens after all the available shares are in the hands of the public? In that case, the price is based on a concept called supply and demand. This concept, known as the law of supply and demand, is an equilibrium between supply and demand. If the demand for a stock is higher than its supply, meaning more people want to buy the stock than sell it, the price increases. On the other hand, when the supply is higher than demand, meaning more people want to sell the stock than buy it, the price decreases. So the price of a stock fluctuates based on the ratio between the supply and the demand of the stock. But what factors influence the supply and demand for a stock? Well, the supply of a stock doesn't change a lot, unless in situations like the company deciding to sell more shares. The demand, on the other hand, is the factor that fluctuates all the time. Some very important factors that influence the demand for a stock are the performance of a company, important news or events, speculations, and economic conditions. So now you understand the basics of the stock market, why a company would sell their shares, and how the price of a share is calculated. You are now ready to learn about the different ways to invest in the stock market. In upcoming videos, we will talk about this and related topics like indexes, day trading, dollar cost averaging, and much more. If this video was helpful, don't forget to give it a thumbs up and subscribe if you want to see more videos like this. Thanks for watching.